please stay up, have a seat, and may I invite the panelists to come on up, please. So we're delighted to have Laura Fox as our moderator for this panel. Laura is a co-founder and managing partner of Streetlife Ventures, which is a seed stage fund investing in urban climate solutions to transform sectors, including mobility, buildings, energy, waste, and water. Previously, Laura was the general manager of City Bike at Lyft and really built this into a 100 million business and really one of the country's largest transportation systems. She has been with Sidewalk Labs, she has been with BCG Digital Ventures, she has advised Bloomberg Philanthropies. Laura, it's great to have you with us. The panel is yours to introduce everyone. Thank you.
Awesome, thank you. And so nice that Patrick gave a great macro view to the market prior to doing this. And I think before we begin, we wanted to make sure that we were kind of catering and speaking to the audience in the room. How many folks in the room identify as being a finance person? Okay, so maybe 10, 15%. How about startups, scale-ups in the room? Okay, a few more, and then government. Okay, great. So we're going to talk about finance, but we're going to try to talk about it in as plain of terms as possible and to get into as many specifics and examples, and so people in the room can really start kind of understanding some of the nuances that Patrick was talking about, because I think that this kind of movement of like, what are the different types of capital? We, in this space, we talk a lot about what are the sources of capital that you're using. So, there's a lot of grants out there right now, especially as mobility is interacting with climate, a lot about local manufacturing and production, a lot of debt, right? And the later stage debt markets, there's revenue-based debt, asset-based debt. It's becoming really interesting even for earlier stage companies, and then equity. And so we're going to talk through how companies use all those different sources of capital in order to build successful companies and scale throughout the life cycle of the company specifically. So we'll get kind of into it and start with a couple questions for the group in total. Before we do that, I'm just going to do quick introductions, not as extensive as John gave for me, so apologies. So if people want to fit in a couple of additional details, we can do that. But on the panel today, in addition to Patrick, we'll just start with kind of earlier stage investors. We have Chris Thomas, the founder and partner of Assembly Ventures. Then on the corporate venture capital side, we have Bryce Kim, who's the head of investments for Hyundai. And then we have Saurabh Jain, the investment director for Volvo Cars Tech Fund. And then on the investment banking side, in addition to Patrick, we have Daniel Kay, the Senior Managing Director of Mobility Investments at Guggenheim Partners. So thank you. So to start this out, we first want to go into a question that's a little bit broader, and everyone's going to bring in their expertise based on the kind of level of maturity that they're working with in this kind of stage of development. I think that slide that Patrick showed that showed different stages of development, everyone here has a particular level of expertise. And so want to start out with a question of what are 1 to 2 specific examples that you're seeing today of companies who are deploying the right capital stack from the beginning, and how is that helping them become successful and become an attractive investment for you specifically? Maybe we'll start with Chris, since you're at the earliest stage here.
Sure, absolutely. I think, can everyone hear me?
Got to flip it, yeah.
That's even better now. Thank you. So I think all of our babies are beautiful in terms of the companies we've invested in, but one example I'll use is a company in our portfolio called Sortira Alloys, Sortira Technology. They're looking at the recycling of end-of-use assets. A vehicle is crushed, it's shredded. How do you use all those materials and put them back into production immediately? And so this was an initial capital stack brought together by players like ourselves at Assembly. We do seed to B investments, Breakthrough Energy Ventures, Crystalix, really getting the go-to-market, the product, and the technology squared away. And then in the most recent round, brought in players like Mitsubishi, like T-Rowe, like Macquarie. And so I'm a big believer you want something that I call a rolling thunder campaign. You want to make sure that you're raising the right amount of capital with the right players at the right stage. And early on, that's going to be people that are very, in my mind, subject matter experts, incredibly deep, and that you have the ability to ensure you're getting that go-to-market really fine-tuned with the right team. And then you're bringing in larger pools of capital from individuals who have the ability to not only bring capital but notoriety to future fundraisers and how the company's growing from an operational perspective. But that's one example of a company I think has done a really good job of kind of building that energy behind their raises from A to B to C.
And maybe one follow-up to that, outside of your equity investment, did that company get any early stage grants or other forms of non-dilutive capital in that early stage?
They are one that had differentiated grant. They have a prolific co-founder who does grant writing as a hobby, I want to say. It's been amazing the amount of non-dilutive grants that they brought in. Our Next Energy, you saw Majib speak earlier. We had the privilege of being one of the institutional investors in their first institutional round. That's one in which we were able to bring $220 million of grant financing from the state of Michigan and hundreds of millions of dollars more in differentiated real estate or tax abatements, given the synergies of them being in that geographic place. And my partner Jessica Robinson and I at Assembly had the ability to uniquely kind of bring that to bear, working with our state because we're based there. And I think that's a great example of kind of, there's different reasons why all of you who are entrepreneurs in the crowd choose an investor, but having those deep networks that aren't just kind of fluff, but genuine and strong, that you can bring that kind of benefit, hundreds of millions of dollars of non-dilutive capital is not nothing. And I think that's where we love to bring value when we can to our companies.
Yeah, and these forms of, we'll continue talking about this over the course of the panel, but these kinds of non-dilutive capital sources are great for founders and great for investors, because at the end of the day, it means that the founder gets to keep a larger percentage of their company as it grows and scales, and for the investor, it's the same on their equity investment. And it just means you can be much more creative as you continue to grow. And
Absolutely.
Yeah, okay, cool. So let's go to the CVC perspective. Saurabh, do you want to start on the Volvo side?
Yeah. I mean, in terms of different stages of the company, we look at more of seed and early stage company series A and B. And at that stage, we see as a strategic venture capital provider, as a corporate venture capital provider, to be able to add value by working with them to get the product to the industrial scale. And as Chris alluded, we want to actually help them be able to get to a product market fit where we see that the product can be taken to the industrial grade. And beyond that, we see that companies which are able to work with us are able to deploy resources to be able to bring that product to that maturity are very successful. So one example I will take is Luminar. We invested in the company in Series A, and both our engineering resources as well as their engineering teams work together to develop the LiDAR to a stage where it can be installed in the car. We worked with the company all the way to the IPO, and we took them live. And today the LiDAR is actually coming in our flagship model, EX90, as a production model. So we see some of these companies being successful primarily because they're focused on their product, on building that technology edge, and then working with the corporate partners to scale it up.
That's an incredible example. Is that something that, when the startup was negotiating with you guys as part of your equity investment, did you say up front, hey, we're going to devote engineering resources, or is that something that just came kind of alongside the equity investment later?
Yeah, so I think wearing the hat of a corporate venture capital investor, whenever we are making investments, we are always looking at the value that we are getting and bringing to the table. At the same time, we're also looking what's the technology fit with the company in terms of our roadmap. So given our ethos of safety and sustainability, we have always been looking at technologies that will help us take the next leap into the safety paradigm. And LiDARs was one of those technologies, incidentally, and we saw that we could have actually we saw the team, Austin as one of the founders and the rest of the team as incredibly being focused on kind of meeting those ethos that we are talking about from an engineering perspective. And of course, as the negotiation happens, there are always elements that we kind of figure out, okay, how do we put some credible resources on in terms of the technology roadmap that the company is developing. So that actually is part of the deal negotiation, but it's not always very crystal clear when we write the check.
That makes a ton of sense. Bryce, how about you guys?
Yeah, so we invest from Series A all the way to a growth stage. So I think there are two functions for CPC. One's early stage incubating, as well as the later stage bringing to market. So on the incubation stage, we have a company called Sonatas, which is the in-vehicle data network company. So that company, we actually seeded the idea and then brought in external VCs, external additional capital, as well as hire the CEO, who are the subject matter expertise. So we're the anchor investor as well as the anchor customer. So it's just they just finished Series B, and then it's already in our vehicle production. So and it's healthy enough to continue to get other external fundings besides the strategics. So I think showing, especially in this climate, showing their material value from very early on, just instead of doing the moonshot approach, is a good strategy in this market. And maybe on the same line, along the same line, on the later stage, I would say that many battery companies, the next generation battery companies, they're at a point that Series B, C and D, that they need a massive amount of capital that's still needed to get to the market. Whereas traditional smaller VCs, they get knocked out, and then there's so limited number of players there. So I think they should be in that stage. They should really be at a point where they're capable of bringing things like joint development or JV with strategic partners or other capital providers. Yeah.
Yeah, and would love to get into that as a double click later too, because I think that that's a really unique kind of offering that CVCs have to bring to corp. Yeah,
just one quick aside, which I think is fascinating. We're talking about a corporate spin-off example from a large multinational OEM, talking about early stage investment in a technology that's core to your forward-going tech plan, talking about more holistic technologies. There's no one right way as to how this is going to come together. And so we have the ability in our fund to also have LPs that are incredibly strategic, like Vontier, like Stellantis, like Mann & Hummel. But whether they're a part of our fund, whether we're co-investing with them, the importance of having partners that are investors that are going to bring more than capital to every entrepreneur in this space. It's going to benefit them just like grant funding in many ways. It's free BD, it's free strategy. It's adjacent, and there's many winners in doing so. But these were just interesting examples.
Yeah, thank you. Okay, so moving on to the investment banking perspective. So company now is progressing through its life cycle. It's getting to kind of the IPO market. What are you looking for, Daniel, at that stage?
Honestly, it's probably not what I'm looking for. It's really what the investors are looking for. Just to clarify, I'm an investment banker. We advise companies and investors on transactions. I don't invest myself. But I guess, traditionally, when you look at companies that are kind of nearing that IPO stage, I guess one of the things that you look for is a company that has steady earnings, a company that you can, if you're the CEO or the CEO of the board of directors, on a quarterly basis have some kind of visibility and confidence that you'll be able to hit your numbers on a profitability basis, right? So it's getting not only to revenues, but all the way down to profitability and maybe even to cash flow. And I would say that many of the companies that over the last 2-3 years, during the COVID era, that went public and through a SPAC, very few of them, if any, probably had that ability. So I think just putting into context what happened a few years ago is probably not the normal. I think it was an exception to the rule, and it was a time when the cost of capital was lowest in pursuing an equity raise through a public vehicle, which is typically not the case and has never been the case with SPACs that have been around for a very long time. And so, I would say that we talked to our equity capital markets team. Businesses should have at a minimum $100 million of revenue is one kind of benchmark, and that's probably at the small end. Many companies are nearing $1 billion, if not above. That they are EBITDA positive, that's again at the very minimum, or have clear visibility to growing rapidly. But I would simply say that the most important thing in this market today is when you think about, and I'm sure I'd love to get Patrick's views, cash flow and profitability are tantamount. And this is true of companies that are thinking of IPOing or companies that have been public for a very long time. Because today the cost of capital, just given what's happened to one, inflation, you're aware that we've had a rapid inflation backdrop, and then two, interest rates. You can earn 4% on a cash account with an Apple Card now. I mean, so as a result of that, investors are looking for mature companies that are yielding cash flow both for their equity and their debt investments. And so the mark of that is a company that is large, that has growth, that has profitability, And when we think about the companies, I think we're talking about this room today, which are really disruptive technology companies, going through a seismic shift, right, around connectivity, electrification, autonomy. These are really big S-curves that are happening over time. It's hard to time it exactly, but it's unclear when those will flip. And so, I think for the time being, venture capital, private capital is probably a better source of capital for companies in that space.
And Patrick, I always love when we agree, but I also love when we disagree. So is there anything that you would say you have a slightly different perspective on? Or, I think one thing that we think about a lot in this industry and mobility, and we were talking about this a little bit in a prep call, is that, takes a lot of CapEx investments into companies to see them grow, to see them hit their first degree of revenue, to see them develop to profitable companies. And so anything different that you would add that you guys are looking for in the IPO side or other trends that you'd call out?
Well, I would throw in a new dimension, and that's speed. Now, just as you saw how the IPO market closed, that really means the market's closed for companies to make that last big hump and get the big amount of money that's really only available in the public markets. And why is that important? You could wait until IPOs restart. But we've got this window of transition with this particular topic of mobility, which is really a decade plus, right? We can't wait 50 years, and we can't develop technologies that need to be in R&D stage for the next decade or two. We need scalable solutions in commercial ways. And so there's quite a few companies that missed the boat of the last IPO wave and then will catch the next wave, but that's throwing a very competitive dimension into the spanners of many companies.
Okay, that's great. And want to dig into a little bit, one more kind of broad point for the group before we get into specific questions, to the point that Chris had made earlier about one of their specific companies that's leveraged a lot of non-dilutive capital. We have someone from the joint office here. The loans program office has done incredible work, really interesting work happening on grants, debt, et cetera. Would be interested to hear if there are other examples that members of this group want to call out that have, leveraged non-dilutive capital in either really meaningful ways for their business or ways that you think are really creative that you want to share with the group.
We've been very assertive in when companies are in positions of strength, which is right after they've raised a round, that then is the time to actually raise debt alongside. And it's incredibly important to be well capitalized. I couldn't agree more on the speed side. But there are things that we control as it relates to our zenith and our speed, and there's other things that we don't. And planning for that worst case, whether it be geopolitics or other scenarios, is incredibly smart. Our hope is always that you never touch it, but making sure that you have the ability to have debt available on reasonable terms given current market rates is something we strongly advise.
I just want to conquer that and share an example of a portfolio company. And this company is basically manufacturing home energy management systems. And each device is about $1,000 plus. So it's a high capex business, and cash flow is always a problem. So they have been able to enter into a debt agreement with some of the banks to be able to both finance the unit whenever they're selling it to a customer, as well as build a steady state of cash that they can use for keeping the working capital going. So these are also some of the examples that in a high capex business like mobility, the companies are kind of using to raise capital and get working capital finance.
So besides the venture debt, given that...
Yeah, let's not talk about venture debt.
Yeah, given that it's so expensive nowadays. I mean, still diluted capital, but I would say that milestone-based equity financing is another way that's getting more popular these days. So it's like you need to hit certain milestones to get more investment, which is diluted. Yeah.
Can you share a little bit more about that with this group? Because I know we have some finance folks in the audience and largely not.
Yeah, I guess for I guess on the battery side, your sample shows a certain level of performance, as well as yield or certain results from your pilot production and things like that. So we keep injecting more money based on the pre-agreed conditions, based on the startup's targets.
Yeah, that's great, and that's oftentimes seen in the debt markets, even at the earliest stage. Green banks are really active in some of the earliest stages of financing for many companies, and will often have these same kinds of performance-based tranches as well. So that's great. Anyone else want to bring up non-dilutive examples later on that you guys think are great as you're presenting companies to the public market or M&A market?
Well, I mean, the DOE loan or the A2EM program, have helped some companies to kind of mount the horse from the other way around, going with debt first, and then some of those grant recipients have not had the equity underneath it, and then go find the equity, which is kind of the other way around than normal corporate finance. But it has resulted in an acceleration of fundraising in some ways.
Okay, great.
I was going to talk about the same example, which is, in Patrick's chart, he had companies that were hitting that scaling phase, so putting up your first gigafactory, putting up your first pilot plant. These are billion-dollar-plus projects. And this is where the U.S. government, through the DOE, has been very supportive. But many of the loans that they're issuing are conditional loans, and they're milestone-based, and some of the milestones actually required, finding equity checks. And so this is a public-private partnership where, I think we need to prime the pump. These are large projects. It's going to take a lot of money. And what the government wants to have is, one, have smart money, professional investors who can validate, as well as strategic companies, customers, partners, who can also validate the technology, the manufacturing processes, making sure that these plants get built, properly. And I think that's, as we open the session today, we were talking about the U.S. and the opportunity here. I think there's a huge opportunity over the next decade to build, a greener, more sustainable future for this country.
Great, thank you. Love that note of hope about what comes next. There's a lot of doom and gloom, right, as we think about the future, and I always like to think about agency and optimism, so always appreciate that. Okay, so how about for CVCs, we started talking a little bit about some of the creative things that you all can do that are not always as well known, because you can do different kinds of JVs. We talked about strategic sourcing. Would love if each of you could just talk about maybe 3 or 4 different things that you all can do as a CVC in this space for these asset-heavy businesses that are quite different than, say, a standard equity investor or a standard debt investor. Bryce, you want to start this time?
Yeah, joint development. So pure equity financing is one. Joint development. We can all certainly become a commercial partner or go-to-market partner channel. And also on certain aspects, especially around electrification, integration with OEMs is critical. So sometimes OEMs are not the direct beneficiary of startups' technology, but for startup to survive, we are a key enabler. So I think starting early with OEMs, getting involved early with OEMs is a good strategic move for startups as well. So in that aspect, at Hyundai, we're a corporate venturing arm, but we have a separate budget to do pilot projects with startups aside from our investment. So we let them do the early stage POCs and validation with us through that budget. That's something that we can provide to startups, given their limited resources, for early stage validation with us as well as other capital market players.
And for any of the startups in the room, do those kinds of pilot opportunities come up as specific calls for application? Do they come up as startups pitch you as part of the CVC?
Both. Sometimes
Both.
we run pitch sessions or call for startups as well as direct contacts or inbound and outbound.
Saurabh?
Yeah, I think the points that Bryce mentioned are relevant. Joint product development, commercial agreements, pilot opportunities are all the areas where we see good engagement with startups to be able to help them. One more area I can look at is many of the startups are actually not focusing only on automotive as a vertical. So there's a sustainable material company that we are working with. They are developing high performance structural elements which out of biodegradable materials. And they are more focusing on, they were until now more focusing on other industries like aerospace, etc. And they reached out to us for doing a pilot on automotive interiors for passenger vehicles specifically. And we became a kind of a launch partner for them, and that also became a reason for giving them equity financing as part of their Series A. So that became like a win-win situation where we became a launch partner for them for the automotive vertical. They also got a testing ground for being able to find that they have suitability in the automotive industry, and then taking the product to other OEMs and other partners in the industry. So that's also an opportunity, I feel, where companies are not directly focusing on the mobility vertical, but it's an element where they can launch the product in the future.
Great. And Chris, back to you. We're talking about these kinds of creative ways of working with startups. There was a panel earlier about how legacy industries like infrastructure can acquire kind of digital technologies or partner or procure. One of your portfolio companies is a digital technology and digital software platform that has now bought out a bunch of legacy assets. Can you talk about what that is, why that makes sense, especially at this moment?
Sure. I mean, I think it only makes sense in very unique scenarios. And as much as the last wave of SPACs didn't make sense, I think the innovation that we're seeing in finance is something that's really exciting for us. And so this is a business that does real-time payment in any parking environment. As of January of 21, they had about 30,000 people on platform. They now have 6 million in North America, more than 2% of the US driving population, a company called Metropolis. So rather than having to use a QR code, grab a ticket, grab some cash, you drive in and out of a parking location, automatic kind of functionality and transactions, and it's a magic experience that after a couple times you will always use. So they have a technology platform, and we co-led their Series B and priced the round. It was a $167 million Series B about a year ago, in which as part of the uses for that transaction at the time, they acquired the 11th largest parking operator in North America. And there were 600 locations on the continent. About 300 already had been metropolized. They deployed their technology so as to allow for this magic experience. And we had a thesis as investors and at the board level that we could convert these other 300, and in doing so see an outrageous revenue lift that went through every aspect of the overall P&L from an operation income to a net income perspective. And that's exactly what we saw. And so when you have a technology-based company that can create more value than any of the incumbents in the space, either the real estate owners or the operators, you have a truly transformational company, and one that you have a lower valued technology asset that can go out and acquire much greater valued legacy physical assets, but do so in a way in which you're going to be able to create that cash flow that Dan was speaking to. So we just announced a $1.1 billion acquisition of SP Plus, which is in process, the largest parking operator in North America. And the ability for this transaction to take place, we're calling this a growth buyout. It's the unique ability for a technology platform to monetize physical assets in ways that they cannot be monetized otherwise. But the beautiful thing about this business is parking is a Trojan horse. They are building a user base, but it is something that can be kind of cascade across all aspects using the vehicle as the payment token for car wash, for charging, for fueling, for C-store, for holistic infrastructure. And so this will not be the last growth buyout. It's the first. And I think it's something that's really interesting and innovative in finance for those of us that kind of live this, and it's one we're really excited about. I sit on this board. As I talked about earlier, all my babies are beautiful. But Alex Israel is an especially beautiful baby. So
that's great. And you start out by saying this isn't right for everyone. Are there certain types of criteria that you think need to be true to consider something like this in terms of a
I think for this structure, you have to have a very unique potpourri of a technology platform that can buy out legacy physical assets and create more value than any other physical operational kind of, either operator or new type of technique that could be brought to that asset otherwise. It has to have some very unique attributes. But Metropolis has done something that no one else has done, in that they've melded the old and the new, and they're building something that is, one, it's a cash machine, by way it's how it's generating cash, but it's generating an experience for the user in which the utility is greater than what's being paid. And that's That's really exciting.
Yeah, that's great. And coming back to the investment banking and IPO market side, we started talking a little bit earlier about this need within the broader capital markets to see positive cash flows. People were IPOing, SPACing, deeply negative just a couple years ago. That's no longer true today. What are the specific trade-offs kind of outside of speed as a point that you all are seeing in terms of companies trying to get there in the short term within the mobility space itself? Are people slowing down on growth in order to get closer to that profitability curve? Are they starting secondary revenue streams? Like, what are a couple of examples that are top of mind?
Maybe I'll go first, and then you can add more. So I think it's really just a paradigm shift. To a certain degree, we had a very low interest rate, macro environment for the last decade or maybe even two. And so that's fed an entire class of companies that may not have existed in a different macro environment. I use Uber as one example. Uber raised $18 billion to fund really customer acquisition costs. And today they've won. And now they're worth almost $100 billion. So clearly that's worked out, and maybe some of the others haven't fared as well. But I think today we're in an environment where certainly at a Series A, Series B, it's not expected for a company to be cash flow positive. That's really, especially in a technology business, in the automotive business, those are probably things that are impossible. And so when you think about technological shifts, you think about business models that could enhance the ability to generate revenue. And so when I think about EV charging, it is probably the perfect example. It's a chicken and egg problem. Without chargers, drivers are going to have a hard time buying electric vehicles. So you need to put the chargers in the ground. This is what Elon Musk did when he built the supercharger network. 10, 15 years ago, a lot of his competitors thought he was crazy. And now today, it's one of the most valuable pieces of his value proposition. So then when you look at the other chargers and public chargers, for example, utilization risk is something that is making it very challenging for any of these companies to generate positive cash flow. Because if you only have 2% of the car park that's electrified, how are you going to have utilization exceed 15, 20%, which is generally the area at which these chargers start to make money. Again, but we need to go back to the chicken and egg. And so maybe there are other ways where you can avoid the utilization risk. Maybe there are other business models where you can cater to different markets, different customers, and have a different kind of an arrangement. And some of the innovations that I've seen that I find really interesting, you can call it EV charging as a service, you can call it infrastructure, but there are companies out there like Terawatt and Volterra, and they're all startups really, but they've been backed by large institutional managers, infrastructure funds. They've got $1 billion plus of capital that they're using to deploy into real estate. And part of the way that they're contracting with their customers is, as opposed to taking on utilization risk, what they have are agreements for whether it's monthly or annual purchases of electricity. And so as a provider of a service, you have visibility into the revenue and then ultimately the cash flows if you plan it well. So from day one, you could be a cash flow positive charging business. And now that's something that we haven't seen over the last decade. Right, but this is a new innovation, and I think it's partly been forced because of the change in the capital markets. Again, I think everyone is trying to solve for a solution that fits, customers. So in this case, fleets and trucking companies. Ultimately, people. We want to have more electrification, and also the capital providers who need to earn a positive return on their money. And what I would simply say is there's a lot of money waiting on the sideline. People always ask me, like, where are we going to get the money from? Well, it's there. The question is, can you demonstrate to the investor a positive path, a high conviction path to return on the capital? And if you can, I think it'll be there.
Patrick, anything to add?
Laura, I was just going to say, just let's keep in mind that there are also all these startups in the crowd. So if you want, we can provide an opportunity for them to ask questions as well.
Sure. Yeah, that sounds great. How about Patrick, if you have anything to add, and then we'll go through quickly, maybe everyone giving the 1 to 2 areas of mobility that they're most excited about, and then open it up for the group.
Yeah, I'll just make one point to emphasize. The unintended consequences of interest rates rising was that things are delayed, but it's really intended consequences, right? Because we need to fight inflation, and you can show that I could show that very easily in a chart. For example, look at the battery companies that are publicly listed. There's about a dozen globally. There's those who produce revenues. Their share price has almost not been affected because they're producing cash flow. Those who are still 3 years away from potentially producing revenues are kind of halfway down, and those who are 5 years more away from revenue generation are 80% down. So there you have it, a real stacking of interest rate weighted cost of capital.
Yeah, that's great. Okay, so to do a quick lightning round, and we'll try to keep it short per each person. There's a lot of talk about how it's hard to make money in transportation. I think this group is demonstrating that that's not the case. You can, and you can be really successful doing that. You can get really creative in terms of sources and uses of capital. But what are 1 to 2 kind of specific areas of mobility that you each are interested in from an investment perspective over, the coming year or two? And don't have to go too deep, but like broader spaces.
Yeah, so from our perspective, energy is becoming a very interesting vertical. We've actually even launched a separate business unit called Volvo Cars Energy Solutions. And within that domain, I think we are looking at charging solutions that can help our customers who will be buying electric vehicles to become both a good experience for them as well as utilize those assets. So there were panels today which were talking about the underutilization of a 100 kilowatt hour battery when you're only utilizing about 10 or 20 kilowatt hours in a day on an average. So how do we kind of convert them into virtual power plants or vehicle to grid or vehicle to home or even kind of assets which can charge the recreational activities that customers generally use cars for. Apart from that, areas around energy storage, home power walls, etc., are also becoming very interesting for us in the short to mid-term. Apart from that, sustainability overall is a big agenda for us. So recycling of materials, batteries, using more sustainable materials in the cars, reducing the carbon footprint of the value chain. These are areas which are very relevant, both from a climate perspective as well as from a business perspective. So these are 2 areas, I think, which are very, very top of our agenda.
Bryce?
So all the topics were covered.
Same.
So I would say
Plus
that these are all great, and also autonomous cars or electrification, all great. But in order to get there, I'm particularly interested in the AI and robotics side to retool our factories to be able to efficiently manufacture and support all those activities and be competitive with our other countries or other competitors.
Yeah, Patrick's numbers on the cost of capital required to change over those lines was stunning.
Yeah.
So understand that pain point.
Yeah.
Daniel.
So I don't think it's appropriate for me to share any particular names. I think I'm interested in all of these spaces. But for me, what's most exciting is finding innovative business models. People who are trying to do the same thing in a very different way. They've got a different mousetrap, a different approach. And it's really just, it's just really encouraging to see people trying it a different way to make it work. I can tell you, I've had many conversations with investors, and they say, I really need to put money to work. My boss has told me I need to put $1 billion to work in sustainability, and I just can't do it because I can't find a good investment. Do you know any cash flow positive company? They'll say, I know a couple, actually. And they'll say, how? Like, can you introduce me? And of course, we introduce them. But what you realize is there are people who are able to, one, run their businesses differently, get their financing differently, maybe use software algorithms to optimize their businesses differently, and that results in a different outcome. And so, I just encourage you to always think outside the box, talk to people, try to do the impossible, because I think that's kind of what it requires to succeed.
Yeah, I'm really excited about the next block of talks and panels about autonomous driving. It's just such an exciting area, and it's futuristic. But if you do come out to San Francisco, since a few weeks we have the public robot taxis there, driverless, fully driverless, available to the public 24 hours, and it's astonishing. There'll be a lot of change following that.
I would say we are also interested in all these things. Just with all due respect to my esteemed colleagues, just call us at assembly first when you're looking at these. But I would say for us, like we define mobility as the physical and digital movement of people, goods, data, and energy. So that's very broad. We look at it through a framework we call ISA, which is Infrastructure, Systems, Applications. So there's lots of different thoughts as it relates to each of those individual silos, but there's two that I'll point out. I'm interested in holistic powertrain. I do not believe in the fever dream of a binary shift from what we're utilizing today with ICE engines to electrification. I'm very long on electrification. I believe we're going to have a huge component of our overall systems powered in those ways in terms of energy storage as well as in the vehicles themselves. But if we are going to transition, we must do so in a sustainable way. And the only sustainable way we're going to transition to clean energy is by creating sustainable companies that are profitable, that exist without subsidy. So we must use all of our energy resources to get to a very clean outcome. And that is that always sparks interesting discussions, but it's the honest way to approach this to ensure that we're listening to our consumers and not berating them and telling them that they're wrong. So I'm excited about all of those companies. And two, I'm interested in personal dignity. And what I mean by that is technologies that enable humans to live their potential, to be fully mobile until the very last day they breathe their last breath. We are seeing not humanoid robotics, which scare the hell out of me, to be honest, but technologies that are bringing freedom of movement and joy and the ability to be with your grandchildren, the ability to recover from illness, the ability for humans to be not constrained by mobility limitations. So my father worked in prosthetics and orthotics his entire career, and he molded leather and wood. He never went to college, he just worked on these prosthetics and orthotics for folks. We have a chance in our generation to change the way humans move for their entire life. And that's exciting to me.
Okay, so now all the startups in the room have a decent sense of what people are looking for. So step one. But are there any specific questions that people want to raise to this panel or things top of mind? Yep, in the back.
So one of you, question for any of you who can comment on this. One of you mentioned about the robo-taxi in San Francisco, but they just hit a major roadblock a few days ago. So in view of that, what's the future from the investor's point of view of self-driving technology? And a second question relating to that is what about the future of delivery vehicles without passenger in them? I'm not talking about the little robots on pavement, but vehicles that actually drive on the roads, such as produced by that company called Neuro from Mountain View. Thank you.
Yeah, I think we have to defer to the next panel. We're not the experts here. But look, when I mentioned that the robotaxi is really just the tip of the iceberg, there's so many controlled environments where automation in the mobility sense can take place. And trucking is one of that, logistics is one of that, warehousing is one of that, restocking of inventory, and there's just so many ways that can go, even beyond the mobility theme. So in that sense, I see it as a very motivating technology-driven progress.
And two quick comments. I had the pleasure of sitting at the board at Nutonomy, which is now Motional, and I think the work they're doing, and we are at the cusp of what autonomy is going to be. I also had the pleasure of being one of the first institutional checks in a company called Gatic. So autonomous middle mile is going to be something that I believe will revolutionize how we think of decreased cost on logistics kind of point-to-point nodes. That's something I think we're again going to see much, much more of. And we have to empirically look at the numbers. It's very scary when we see what happened in San Francisco. But if you look at empirically as the safety of those rides, either for humans or logistics, every day it gets better. And we as humans need to come to a point where we can say, if this is 3x better in terms of safety on the roads, but there are situations in which that system's still working, that means it's better for humanity. It's just different. And so that's something I think we need to be honest about.
Just quickly, those robotaxi or the autonomous driving companies who are running robotaxi pilots, they're actually losing money by running those pilots. So as long as it's a short pause, I don't think they're too unhappy about that.
Stop losing money.
So if I could I'll try to actually take a guess at that question, or maybe I'll give you my perspective, maybe a little bit more of a sober perspective. Look, I think any company that has had a historic valuation, raising lots of capital, over the last decade, you can't outrun gravity forever, is how I feel. And the question will be, when investors evaluate them, no, they're not going to expect cash flow tomorrow. However, they're going to risk adjust the ability to see terminal value coming up closer. So, when I think about what happened in the SPAC boom, I mean, all of you could see it. They put it on a PowerPoint presentation as the very last page of every single presentation. And it was basically taking a hockey stick, putting a high multiple, maybe a reasonable multiple, and then discounting it at a very, very low cost of capital. And that works when your interest rates are zero, and you're sitting at home and you're not really interacting with people, and you have retail investors who are driving a lot of the market. But I would say when you have large institutional, very sophisticated investors who are thinking about what do the cash flows look like over the next 3, 5, 10, maybe 20 years, and then start to develop a view around terminal value, and then think about their cost of capital, that's when, and then you look at the business plans. I think that's when you're going to have a more sober, perspective. One of my partner, John Casessa, he was at Ford when they created Argo AI. And many of us in this room know what happened to Argo AI. That was a very unfortunate outcome. But it is an outcome, and I think it's something that's, Volkswagen, Ford, others, it's just as you think about the draws on capital, where the strategic priorities are, maybe your, an assessment of your right to win, I think you're going to start to see consolidation, and that's what's happening. So whether you're looking at the LiDAR space, you're looking at the mapping space, this is going to happen little by little, and you will start to see winners emerge. And I think once that happens, you'll have market power. And you use Uber as an example. Uber turned profitable this year. And it's amazing that they weren't until this year, but they figured out how to do it. And now they're the winner in the space.
I have thoughts on this, but I want to see if there's other questions in the room. There are. David? Do you want to...
Thanks. Hi, I'm David Zipper. My question's actually about a sector that could really benefit from some of the innovation and finance you guys are talking about. Public transit, which we just heard, it really has its back against the wall. We all know it. The agencies could really use some ideas for how to be more innovative and improve their operations and get back on their feet. And societally, I would argue that if transit is in a stronger position, that might actually create more benefits for society, or at least as many, I would say, as the AVs and EVs that dominate a lot of discussion. So I don't think transit came up in this conversation. So I guess I'm curious if you see any opportunities for the private markets to support innovation in public transit, or is saving transit going to have to come from other parts of society entirely?
I would love to start with this one. I completely agree and think that public transit is an exciting space. I think that there's both the need to work on the private market side and the public market side, and maybe starting on the public side. I think we've been talking about this in a couple smaller groups, but I think things like challenge-based procurement are really exciting. Challenge-based procurement came up a little bit earlier, but it's essentially where a public agency will put out essentially a pilot in the form of a challenge. So it's a formal procurement process. They put out specific KPIs that startup needs to hit as they go through that pilot phase. And if that startup hits those KPIs, then the agency through procurement law is actually able to procure that startup at a level of scale and can do things like advance market commitments to kind of put dollars in the bank to do that. And so I think the more that we're able to have those kinds of structures on the public market side, I think the more startups are going to want to build for that market, because it's a very large market. And I think some specific interesting technologies in that space, a lot of us have been excited about and talked about things like automated ticketing in buses and those kinds of aspects to add both revenues to transit, and then also to kind of use and manage roadways in a digitally managed way. I think we've talked about things like, how do you deliver in the same way that Metropolis delivers, services to people who are in parking garages? Could you actually be giving people like coupons to the latest Starbucks or whatever kind of retail offering is close by? Can you do retail offerings within transit? Sponsorship opportunities? Like, there's a lot of ways to generate money. And even beyond that, congestion pricing, parking fees, all of that. And so I think that there are those kinds of opportunities, and how we match the kind of political cycle and procurement to the politics are a really important part. Anyone else want to add to that or think through this as part of kind of their investment strategy?
I would just add that I think the way that we have innovation in public transit is if we get rid of sacred cows. And what I mean by that is that the public purse is exactly that. and the way in which we can best serve the citizenry should supersede any other organization, leadership group, or union. And we should be looking very specifically, looking at companies like VIA. If VIA can get an 80% utilization rate, better service a geospatial, and can do so in a way in which no one is left out, and that's a key point. It can't be that there's a technology shift where all of us in this room have the newest iPhone, but someone who's used to paying with cash can't. But if we can do that well, we must get away from the idea that any government program or agency that serves public transit should not be changed 100%. And if we approach it that way, and people know that they have to deliver services to the citizenry with the public purse in a way that actually delivers and doesn't move ridership from 5 to 6%, we'll see a lot of innovation.
And I'll just maybe add one thing on top of that that I think came up on one of the earlier panels that's maybe like an intermediary step, which the CFO of Chicago kind of made a great point earlier about VIA being great at building a vision for what it's trying to do, and what if public transit agencies also built that kind of vision, strategy, aggregated demand. So again, the private sector knew what public sector needed, wanted, and so could kind of deliver against that on this roadmap to kind of taking out sacred cows. But if we can't go from 0 to 100, can we go from 0 to 20 to 50, et cetera? Okay, we are out of time, but everyone here will be around later, so thank you all.